What we are going to do at this time around for the next few days is try and get you companies which have done really well, not just on a YOY basis, but also a QOQ basis. Power Mech is one such company. The last few months have been rewarding for the company as well. The company bagging 5 big contracts since February, and the markets have also rewarded the stock largely on the back of the order wins, but more importantly, the kind of financial performance that the company is clocked in, as we said, both on a YOY and a QOQ basis. Let's try and figure out if this performance can continue. Kishore Babu, Chairman and Managing Director at Power Mech Projects, joins us right now on the show to talk about that. Good afternoon, Mr. Babu. Thanks so much for joining in. I want to talk about everything from order flows to the financial performance to the debt numbers as well. Let's start off with what you did in Q3. Strong performance both on a YOY and a QOQ basis, which shows consistency. Do you think these numbers, or do you think you'll be able to maintain the pace of growth that you've shown thus far?
Yes, these numbers will be maintained. Right now we have an order book of around 8,000 crores. And confidently we can say for next 2 years, we will have a growth rate at the rate of 30% our revenues.
Sorry, did I hear you say you will see a growth rate of 30% for the next few quarters?
Yes. Next 2019, FY19 and FY20.
Okay, so FY19 and FY20, a CAGR growth rate of 30% on the revenue front. Is this on the back of the current order book alone, or do you reckon that the order inflow will only strengthen over the course of the next few quarters?
Yeah, the present orders what we have in hand, that itself is going to strengthen our financials in next couple of years. And in further, we don't require much orders inflow in next financial year. But anyhow, we have planned next year also around 5,000 crores order inflow in 1920. Similarly, this financial year 19, total inflow of our orders is around 5,000 crores.
Okay. What's the number look like in the last quarter? I mean, a lot of people believe that for a lot of EPC stroke government order backed companies, now that the election dates are out, the order inflows and maybe even execution will slow down.
Sir, we have a mix in our execution. We have O&M. Around 20% of our revenues comes from the operation and maintenance of thermal power plants and gas power plants. And we have international operations. We are operating in 6 countries. And also we are doing this around 1,000 kilometers cross-country pipeline for IOCL. And also we are working for the transmission distribution of power lines for Power Grid, Nagaland and Assam. Because of the mix in our total in our business, I don't think these elections or anything will disturb our top line and as well as our values.
Okay, so let's talk about what happens in the next few quarters. As I see your trajectory, and that's the reason why we got you. As I see your trajectory, your numbers have consistently moved up. Q1 2018, about 350 odd crores of revenues that inched up to 490, 500 odd crores, 535 in Q2, 610 in Q3. What is the quarterly run rate likely to be as we move into Q2 and Q3 FY20?
FY20?
Yes.
FY20 Q1 and Q2 will be, when comparing with the 19, it will be a 25% growth will be there in Q1 and Q2.
Okay. And will this growth come at the cost of margins? Because when I see your Q3 numbers as well, the rising share of civil works have impacted margins. So your revenues have moved up, but your EBITDA margins have come off.
No, EBITDA margins also, you see, this year 19, the coming balance sheet which we are going to show in by 31st March 19, we have a growth of around 38% in EBITDA and PAT of growth of around 39%. And similarly, the next year, it may not be that much and it will be around 25 to 30%.
Okay. No, so can you give me some sense of what your margins could look like? Will it be steady at this 12.5, 13% or is there a chance of them moving up?
It will be more or less in the same, sir, in the same range of 13 to 14% of EBITDA.
Okay. And the other thing that stood out in Q3, while you gave out strong numbers, was the finance costs, which were higher due to the rising debt. I think the current debt has inched up from what it was. It's manageable, I'm sure, but it's higher than what it was. Do you
Yes,
believe?
it is there, but it is there. I'll tell you because of the slowdown in the power sector, we have closed around 40 projects in power sector, sir, for last 1 year. That is why in any project, when the project is in a closed stage, we have to infuse of more funds. That is why our debt is increased. The next coming years, whatever the retention monies and the final bills which are accumulated in these power projects will come out. With that, confidently I can say that our debt rate will come down to minimum level, and my target is to make the debt zero by 2021.
Debt zero by 2021. Okay, so that's interesting, and we'll of course monitor that too. The other question would be the rising cost of funds. Almost every NBFC that we speak to says that their cost of funds have moved up, and consequently the rates at which they lend has gone up too. What's been your experience? Banks, NBFCs, wherever you borrow from, has the cost of borrowing inched up?
No, our average cost of borrowing is around 9.1%, and our A-rated company, and we are still maintaining that. In future, I can have more leverage to negotiate with the banks to can reduce my debt to below 9%. Even today, I have a term loan with the Bank of Bahrain with 8.5%.
Okay, so let's work with the assumption that your revenues grow up to 30-odd%, something that you just guided to, 25-30-odd% circa. Your margins stay at 13 to 14%, and your debt will come off over the next couple of years. Are we to assume that your bottom line growth numbers will also be at least 30%, maybe even more, with the reduction in debt and reduction in interest costs?
Yes, naturally, because when the debt, interest cost, finance cost is coming down, the bottom numbers also will move in the same fashion, between 25 to 30% like that growth.
What's the guidance you can leave us with for Q4? You think a PAT of 110 to 120 crores is achievable?
Yeah, sure, it will be achievable.
And a 30 to 35% growth on that in FY20 is what you're targeting?
Exactly, sir.
And you won't need to raise any kind of monies, equity or otherwise, for any of these execution. Are you looking to raise any equity funds?
Right now we are not planning anything, but now the projects which now in hand now, we are having mobilization advances also quite comfortable. If it is required still in future, we may plan some QIP in the next coming years.
Okay, but not in FY20?
No.
Okay. Keep up the good work, Mr. Babu. Thank you so much for taking the time out and joining us, and all the best for the quarters ahead.
Thank you so much. Bye.
That's Power Mech Projects. Strong performance both on a QOQ, YY basis. The 9-month performance is strong. The management believes a 25 to 30% growth on the top line is something that is easily achievable or definitely achievable. And margins will stay steady. Debt will come off by FY21. They intend to become a zero debt company.